Hello, I'm Peter Griffin from U Asset Management. You'll have seen in lots of investment commentary, and indeed in lots of the U Asset Management commentary we produce on a regular basis, the word diversification. We're here to have a brief explainer on what diversification is and in the context of U Asset Management. To help us through that, we've got here Chris Ayton, U Asset Management Fund Manager. Hi Chris.
Morning Peter.
To begin then, what does diversification mean in the context of U Asset Management portfolios?
Well, for us it's very much about not putting all your eggs in one basket. So we're big subscribers to the John Templeton view that the only investors who shouldn't diversify are those who are right 100% of the time. And as fund managers, we have to appreciate that we're not going to be right 100% of the time. And we observe that those managers out there who maybe try and make these heroic asset allocation calls, maybe all into equity and then into cash or gold or whatever it may be, have a much lower probability of success. So for us, what's proved to be successful over decades now is to ensure that our portfolios always have multiple layers of diversification within the portfolio. So we have diversification by asset class, diversification by region, and diversification by investment style. And by having those multiple layers of diversification in the portfolio, not only has that enabled us to generate very strong returns over the long term, but we've also been able to smooth the journey. So we've been able to provide our clients with a smoother run and give them the best opportunity of achieving their financial goals over the long term.
And so from reading your paper, I got the impression sometimes you might hold an asset even if you don't think that asset will have in isolation the best long-term returns.
Yeah, it's a good point. So over the very long term, we would expect equities to provide the best returns over long time periods. But as we know, they can be extremely volatile in the short term and with significant drawdowns. So in our more aggressive funds like the Adventurous Fund, we do hold almost exclusively equities, but we still have within there diversification by region and diversification by investment style. But as I say, we appreciate over shorter time periods that can be quite a volatile ride. So for our other clients, where that's not appropriate, we include multiple layers of diversifying strategies within the portfolios. And these diversifying strategies can kick in when equities are maybe going through a more challenging period. And we break those diversifiers down into three different components. We have fixed income. So we have a very globally diversified portfolio of fixed income securities. And then we have real assets. Real assets are strategies that have embedded with them some form of inflation sensitivity. So when you get those bouts of inflation, these strategies can actually be quite helpful to the portfolio. So within that component, we have things like trend following strategies. We have global infrastructure, infrastructure equities that have revenues that are contractually linked to inflation. So it can be quite a helpful part of the portfolio in those sort of environments. And then finally, we have a third string, which is called absolute return. These are strategies that are designed to provide a positive absolute return over time. But critically for us, they do so in a way that isn't dependent upon the direction of equity or fixed income markets. So it's a very independent return stream that can provide and has provided some nice protection and positive return for the portfolio in those environments where equities have been going through some period of stress.
Going back to the equity portfolio just for the moment, within each equity asset class, what benefit is there to be had then from not simply buying the market?
Well, we think there's a role for both active and passive strategies within a portfolio. And for us, it's very much dependent upon the asset class which we go down. So within our multi-asset blend funds, where we have the greatest flexibility to use both strategies, we do use both active and passive strategies within those portfolios. So for example, within our global fixed income portfolios, we have a core holding within a passive index fund that invests in high quality treasury bonds around the globe. And alongside that, we have some active strategies that invest in areas that we think are particularly attractive at that point in time. So at the moment, we have some exposure to local emerging market debt. It's been very helpful to the portfolios. In the past, we've had exposure to some China bonds within that part of the portfolio, again, providing a very differentiated return stream. But that portfolio is very globally diversified. Within our equity portfolios, we break that down into different regions, and our choice of active, passive, or a blend of both really depends upon the characteristics of each of those individual markets. So in the US, within the large cap component, we've predominantly gone down the route of using index funds for that because it's the most efficient market globally. And we find that active managers have historically struggled to beat the market. So we've tended to use passive strategies within that component of the portfolio. Within small cap in the US, it's much less efficient. So you can generate some added value through active management there. But if I contrast that with maybe emerging markets, which remain some of the most inefficient markets out there, there's probably the biggest divergence between good and bad economies, good and bad companies, good and bad management teams. That's a market area where active management can really deliver you substantial added value over and above what you would get in an index fund. So within our emerging markets component, we're almost entirely invested with active managers, and we use 3 different managers who invest in different ways across different parts of emerging markets.
Excellent. Following on from that point, you mentioned blending 2 or 3 different active investment styles together within an asset class. How do you go about building that together?
Well, just as we think timing in and out of markets is very challenging, timing which investment style is going to be working at one particular point in time is equally, if not more difficult. Just look at the US over the last year or so. We've gone through a period where high growth technology companies like the Magnificent Seven have really driven the US market higher for some period of time until earlier this year. We've just seen at the flick of a switch, they've become the biggest underperformers over the more recent past. So for us, within our equity components, not only do we diversify by region, but we also diversify by investment style within those different regions. And we've developed some quite sophisticated internal systems that help us with that blending process. Enables us to blend together active managers that we think will all outperform over the long term, but by blending them together in a sensible way, you can smooth that ride, and your outperformance can be much less volatile than if you just took a single bet on one particular style being in or out of favour at that point in time. So within that emerging markets component I referred to earlier, we use 3 different active managers, all who have very different investment styles. We have one who focuses upon the highest growth companies across Asia and emerging markets. That strategy tends to do quite well in strong market environments. We have a second manager who invests with a very different style, what we would call a value style. So he's out there trying to find, bargain assets, companies that may be out of favour at one particular point in time, but where they think the long-term potential for those companies is still very strong. And then we have a third manager who invests with more what we call a quality style. So they invest in the highest quality businesses and the highest quality management teams across emerging markets. And that strategy also does well over time, but critically tends to do particularly well in more challenging markets. So when you blend together these 3 different managers, all of whom we think will do well over time, you end up with a much smoother ride over time than you would if you just bet on one particular style working at one particular point in time.
Fantastic. Thanks, Chris. That's all been really useful. It's great to hear about diversification in action, and in particular how that really benefits our investors directly in our portfolios. If you want to read more about that, we have a client guide on the U Asset Management website with a full report written by Chris exactly on this subject. Thank you very much.